Good morning, ladies and gentlemen. Welcome to the SDCL Energy Efficiency Income Trust PLC interim results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Jonathan Maxwell, CEO of SDCL Energy Efficiency Income Trust PLC. Good morning, Jonathan.
Good morning. Thank you very much for the invitation to present. Great. Well, welcome everybody to the results presentation today, and I will take you through the discussion. Hopefully, keep it relatively brief, and then we can open up for questions afterwards. Just introducing myself, Jonathan Maxwell, founder and CEO of SDCL, the investment manager of SEIT, and also Eugene Kinghorn, who's on the line. Eugene Kinghorn is the group CFO of SDCL and looks after the financial control of SEIT. So just to dive in and to remind everybody, as usual, why we're here to talk about energy efficiency. The reason we're investing in energy efficiency is that we believe that energy efficiency is going to be one of the most going to continue to be one of the most important sectors of the infrastructure investment market for the next decade. The rationale is that energy, which is worth trillions of dollars, and on which everybody and everything depends, and which is at the heart of the problem as well as the solutions to climate change. Energy is mostly wasted. Most of it is wasted. The world actually wastes some 2/3 to 3/4 of its energy through inefficiencies either on the supply or the demand side. And SDCL and SEIT, this investment company, invest in solutions to that problem. It's one of the biggest opportunities of investment in the energy sector for the next decade. Energy efficiency, we think, is not the whole solution to decarbonisation of energy, but it's probably half of it or more. Indeed, the International Energy Agency itself says that energy efficiency represents more than 40% of the emissions abatement needed by 2040. And the important thing there is that energy efficiency technologies exist today. They're readily available, they're widely tested, and they're successful. So energy efficiency is and deserves increasingly to be at the center stage of our thinking around investment in decarbonising the energy sector. And the extremely interesting feature of energy efficiency, that is creating the same or more economic output with less energy input. It's more profitable than business as usual. It cuts costs, it cuts emissions, it improves reliability and resilience of supply. It's an extremely important ingredient to productivity for countries and indeed for profitability for companies. It needs, we say, to take centre stage alongside commitments to cut methane, deforestation, coal, petrol and diesel cars, as it did finally at this year's United Nations Climate Change Conference, COP26, held in Glasgow in the first couple of weeks of November this year. And we were delighted that the Glasgow Climate Pact called for energy efficiency at the same time as it called for clean power generation. A really important fundamental statement that clean power generation is a very important component of decarbonising our future, but so is energy efficiency at least as much. The issue with energy efficiency is, although it's at least as important as clean power, it's probably attracted less than 10% of the capital. So very, very interesting opportunity for investment. And we're delighted that SDCL's Energy Efficiency Income Trust is perfectly positioned, I think, for the next 10 years. The International Energy Agency, couldn't help myself but include this quote. Says Fatih Birol, the executive director, says that energy efficiency is the first fuel. It still represents the cleanest and in most cases the cheapest way to meet our energy needs. And indeed, that's what SEIT is all about: cheaper, cleaner, more reliable energy solutions. Now, SEIT, the SDCL Energy Efficiency Income Trust, was the first, and it remains the largest London Stock Exchange listed energy efficiency focused investment company. And today we're going to be talking about the results for the last 6 months. And I think just taking a couple of opportunities to look back at the period since our IPO about 3 years ago. 5 key points. First, performance. So the net asset value per share in this period we're reporting on, which is the 6 months to the end of September 2021, was up 2% or 2p to 104.5p. That represents a total return in the period on an NAV total return basis of 4.7% and 7.1% per annum since IPO. Investors who are with us from the beginning might remember that we were looking for a 7% plus, 7 to 8% target IRR from IPO. We're well on track to deliver that at this stage of the year. I think we're very well positioned to finish the year very well as well. Dividends, we've declared during the period 2.81p of dividends, which is up from 2.75p this time last year. Crucially covered both by earnings and by cash. And delighted that shareholder total return since IPO, just over 30%, 32% total shareholder return versus about 10% on the all share over the same period. The company is scaled up during this period. Gross asset value has increased to £950 million, up from £700 million in March 2021, thanks largely to a £250 million oversubscribed placing in September, the largest conducted by the company to date. That fundraising actually pushed the company over the £1 billion equity market capitalization by the end of this period, and it was subsequently admitted to the FTSE 250 index. Investment activity during the period has been strong. I mentioned that we've raised 250 million recently, but we also raised money during the first half of the year, which we have deployed. So during the 6 months ended the 30th of September 2021, we actually made about 250 million pounds of investments. During the period, 5 new investments, 4 follow-on commitments, and after the period, 41 million of 2 new investments and 3 follow-on investments. Roughly half of the investments that we've made have been follow-on by number, and roughly half have been new investments. This is a theme I'll come back to. We've described in the past the fact that this company, coming on to the next stage point, has a significant now competitive advantage. It's got a consistent track record of delivering returns and investing capital. And we're investing capital in 2 ways. And first, actually, is off the back of an organic pipeline. This is what we mean by follow-on investments. The company now has scale, and that scale delivers it competitive advantage, and of course, the opportunity to invest in new projects or acquisition that are going to be EBIT and NAV enhancing. So, consistent track record of investing and getting returns. And then the second point I think is important also is, the expertise and leadership for the company and for SDCL in terms of sustainability. And I'm delighted that post-period we published our ESG report. So that was in November 2021 and available on the company's website, seitplc.com. From a governance perspective, many thanks to shareholders for supporting a clarification of our policy and adjustment to the gearing ratios within the company, which were all approved at the AGM on the 10th of August 2021. And I'm pleased to say that the board is recruiting a 5th director, about which more shortly. Regarding evolution of the share price since IPO, we're pleased that the company has generally outperformed the main market. Obviously, the company came back more quickly than the rest of the market in the COVID correction, Q1, Q2, 2020. Since when it's continued to be relatively stable and outperform. Very pleased to say that we've generated significant returns, but also managed to raise capital in the blue boxes and deploy it in the black inscriptions expeditiously. So to the point I made before, we raised 160 million in a placing in February and invested it before we came back to the market in September and raised 250 million. And we are half to 2/3 of the way through investing that too. So company is well on track. Quick update on the portfolio before handing across to Eugene on finance. So during the period, we made new investments. So this is a sample of 5 of the investments that we made since March 2021. We categorize our portfolio really into 3 main areas. So first is cleaner and more efficient supply. That is, cutting out these extraordinary generation, transmission, and distribution losses, which means that the world wastes about 2/3 of the energy before it gets to the point of use. And we replace that sort of centralized, inefficient, often grid-connected supply of energy with on-site generation, what we call cleaner and more efficient supply of energy, on-site or near-site generation. So that's one of the key areas for our investments. The second key area for our investments is in demand, in reducing demand, what we call point of use or demand reduction, reducing the amount of energy that buildings, industry, and transport need. Buildings, industry, and transport on the demand side represents 70% of all the world's energy use. So cutting demand, cutting cost, decarbonizing, that's absolutely key on the demand side. And then the distribution side in the middle, we call green energy distribution. So this is basically taking green energy from where it's produced to green energy where it's needed, typically in and around the transport sector. So each of these new investments that we've made during the period, we've classified either as cleaner and more efficient supply, green energy distribution, or indeed point of use, supply, distribution, and demand. And in some cases, a couple of these projects actually tick more than one box. Example, Biotown, up at the top there. So this is converting agricultural and food waste that would otherwise be polluting and disposed of into useful production. So we're using the agricultural and food waste to create biogas, and that biogas is then used to generate energy on site, but also to inject into the gas grid to provide green gas supply, and in return for long-term contracted offtake agreements. So again, everything SEEIT is looking for is long-term contracted cash flows. Tala Hospital is one of the largest hospitals in Ireland. We were delighted to be in a position to finance the retrofit of that hospital with energy efficient equipment. So we're delivering on-site energy generation that's more efficient, as well as investing in solutions that reduce demand for energy across the hospital. So thrilled to be entering the Irish healthcare market with that deal for SEEIT. It's an area that we as SDCL have been involved with for a long time. Just to demonstrate more to the diversification of our portfolio, we've also now delighted to have made an investment in the Sustainable Living Innovations project. So that's the energy efficiency systems and on-site generation that is going to make the greenest apartment building in Seattle, but perhaps more importantly, the first certified net zero energy multifamily apartment building in the world of its kind. Really excited to be able to support that kind of initiative with SEEIT. So we've talked about agricultural and food waste to long-term contracted revenues associated with energy. We've talked about hospitals and long-term contract to run the energy solutions for a hospital. We talked about apartment buildings. So diversification takes us out into the industrial sector now. Primary energy was an investment that we made about 18 months ago originally. And we were pleased at the time to have acquired 50%. We stepped up our stake to 65%. And then I'm delighted to say, post the fundraising in September, we increased our stake from 65 to 100%. So SEEIT is now 100% owner of primary energy. That is a series of projects which, for the large part, recycle waste gases coming off of steel mills, blast furnaces. Those waste gases would otherwise be polluting. Instead, they're actually being recycled and put back through turbines to create power and steam for the steel mills. A fantastic example of emissions reduction, clean energy supply, and cleaner and more affordable energy for the end customer, which means that one of the reasons we were able to recontract one of the 5 projects there in the middle of last year. And then finally, from a diversification perspective, delighted a couple of weeks ago to have been able to invest in the FES lighting project at the bottom here. So that's lighting as a service, mostly for small, medium-sized companies, some large companies across the US. Eugene, I think we picked up 1,000 contracts as part of that portfolio acquisition. And not only did we invest in the underlying projects, but we've also been able to acquire 50% of the company that developed them, which gives SEEIT, I think, a fantastic opportunity to roll out lighting as a service with its partners in the United States. So more diversification, more income, more support for our capital base, and more opportunity for growth in the future through these investments. We've actually listed out here all of the investments that we've made from to the 30th of September, and then subsequently to date. You can expect to see more news from us again shortly, but it's been an active period since the year end. 14 investments, as I said, about half of which were follow on by number, about half of which were new investments. In terms of key portfolio updates, I made the point that we're very pleased now to be 100% owner of Primary Energy. I think it gives us a great opportunity actually to expand our efforts with existing off-takers, and indeed potentially to leverage the platform to find other opportunities in and around Indiana, where this is based, as well as potentially outside in other states in the US. I'm extremely excited to be owning 100% of the 5 projects in Primary Energy. Red Rochester is the large district energy system that we invested in at the first half of this year, and that's up in upstate New York. That's the old Eastman Kodak business park. We own the energy and utilities, 16 utility services, serving over 100 customers across that estate, providing cheaper, cleaner, more reliable on-site energy solutions. Extremely pleased to finish the 100-day onboarding plan post-investment, and now looking at actively pursuing value-add opportunities by expanding services across the business park and the surrounding areas. Oliver Spanish Cogeneration, from an asset performance perspective, has been operating well. We have taken active asset management steps that have now translated into returns for the fund and profits, and that includes, for example, bringing in our fuel procurement in-house, which has added value. We will see, and we said this when we first announced the deal, we will see short-term fluctuations in revenues, albeit that they are designed to be mitigated over the longer term through the market incentives that we have in place in Spain, so that over the medium to long term, we'll expect to see stable and predictable cash flows coming out of this investment. One of the fluctuations that we've seen has been on EU ETS or carbon prices, which are part and parcel of the overall market incentive regime in Spain. So we've taken some short-term provisions against short-term volatility in that market, but we're very happy and optimistic about the outcome and our opportunity set in that portfolio of 9 projects in Spain. Onyx Renewables is the large portfolio, so 200 separate projects when we made the acquisition, more coming through. This is solar and storage throughout the United States. We own operating assets, projects under construction, and a near-term development pipeline. And indeed, SEEIT also has 50% of the underlying development platform in partnership with Blackstone, which is the largest commercial and industrial real estate owner in the United States. So really excited about the future for Onyx as well. We have seen some short-term impact from COVID-19 impacting decision-making with off-takers, slowing down some elements of construction and development. On the other hand, we're seeing the pipeline develop extremely well. So I'm happy with the performance. Vattengas is actually Stockholm's gas grid, which is today about 80% biogas, taking, for example, waste gases off the wastewater treatment plants and distributing them to customers, residential, commercial, and indeed transport customers across Stockholm. This is the Stockholm gas grid. Our asset management team is actively working on improvements to our margins. So we're again pleased with the cash generation of the business and the portfolio, but actually taking active steps to reduce customer churn, grow revenues by cross-selling across the estate, potentially going upstream to increase our biogas productions, and generally increasing where we can our margins and then making sure our costs are streamlined. Huntsman Energy Centre commissioning continues. Minor technical delays, some equipment that needed to be reordered. We're going to be in full operations in 2022. We have, having said that, reviewed our contracts with counterparties during 2021 and made sure that they're appropriately adjusted to mitigate the financial impact of the construction delay. Key risks and mitigants. This is I think a topic for anybody investing with SEEIT that you'll be fairly familiar with. I'll tell you the risks that we worry about, but I'll also tell you the risks that we worry about so much that we try and eliminate them before they get into our portfolio. So maybe I'll start there. I think it's fair to say that the energy market has been volatile generally over the course of the last few months. Energy markets have been gyrating, but SEEIT's portfolio has been quite well positioned against that context. In fact, very well positioned. SEEIT's portfolio seeks to have long-term predetermined or contracted returns or revenues from its project investments. We seek to significantly mitigate, if not eliminate, exposure to day-to-day movements in the energy markets. So we've had relatively little impact from what's otherwise been pretty wild movements in the energy markets, and therefore very stable effect on our portfolio and ultimately feeding through to stability on our valuations. So that's one sort of key area. Another key area that we tried to mitigate is exposure to demand or volume risk. Most of our projects are contracted on predetermined terms where we get paid to make assets available for use. Some of our projects have some linkage to demand, but where we've got take or pay arrangements. If we haven't got take or pay arrangements, we're typically producing much less energy than the company needs, what we call sort of capacity style contracting. So as a result, our portfolio has been stable compared to other, what would otherwise be a fairly volatile period. In fact, a fairly volatile couple of years from a global energy and demand perspective. We've been stable throughout. Our assets have continued to operate. The three key risks that we concern ourselves very much with are credit and counterparty risk, operational risk, and other global macroeconomic factors. Starting with credit counterparty risk, most of our investments are investment grade counterparty or related to investment grade counterparties. Where we don't have investment grade counterparties per se, we have a huge amount of work we do on the role that the assets that we're providing energy to play in their economies, to make sure that if there is any downturn in the economy, the energy is still going to be needed. And indeed, even if the existing owner of a building has a credit event, we're comfortable that we're going to be providing energy to a valuable building that's going to be owned by somebody else going forward. So credit and counterparty risk is a really important area for us, significant area of focus. I'm also pleased to say, with Eugene picking up, maybe referencing this later, that we've had no significant credit defaults across any of our portfolio assets over the last, since IPO. Operational risk is another key area of focus. I think the best way to describe mitigation of operational risk is focusing on investing in projects with technologies that are commercially proven, where we've got appropriate guarantees, warranties on availability, performance, and efficiency, where we've got tier one suppliers providing operation and maintenance services to us. And also, I think a key factor for SEEIT is that we've actually got approximately 300 full-time employees at portfolio company level, with a huge focus at our level as fund manager on asset management, looking after these assets and making sure they're performing. Again, we've had very strong operational performance across our entire portfolio. Finally, on global macro factors, we've been taking very careful, comprehensive tax and structuring advice to make sure that we're efficient across the group. Eugene will give a sense of sensitivity to tax, but we've been able to manage well to date. We've tilted the portfolio slightly into the inflationary tailwinds. So as we've seen inflation levels pick up, we have invested to take a little bit more exposure to the inflation trends than we had before. Foreign exchange is a key area for us. A very large part of our portfolio, more than 50% in the United States, about 35% in Europe. We've had a very successful Forex hedging strategy from the beginning with no material losses or gains from our FX overall on our NAV. And I'll let Eugene talk about that a bit later. Just moving on to the next slide and then hand over on finance. We give a sense of the diversification of the portfolio by a number of factors. On the top there by project, on the bottom by technology. So we're very pleased that we've got a sort of range of technologies, everything from CHP to solar and storage, industrial process efficiencies, lighting as per reference previously. But we also diversify by country and life cycle stage. Just over half of the portfolio by values in the United States today. Very good chunk in continental Europe, Sweden, Spain, Ireland in particular. And also in the UK, about 7%, although we expect that number of 7% to grow, given particularly our focus on electric vehicle charging infrastructure here in the UK, as well as other interesting opportunities we're working on right now. That cash position of 18% was as at the 30th of September. That cash position is no longer 18%. Eugene will come on to that later. It's probably around £100 million, so closer to 10%. Life cycle stage, 70% of the portfolio by value, including the cash, is operational. So if you strip out the cash, the vast majority of the investments are operational, although we do have assets under construction and development. That's well within the budget limits. Eugene, if you don't mind, can I hand over across to you to talk about projected cash flows and indeed the financial performance of the company?
Thank you, Jonathan, and a very good morning to all of you. So on slide 14, the slide we're looking at right now is, and as we have done previously, we show you an illustration of the projected cash flows. This is based on an initial 950 million portfolio, and we've used the same assumptions as the September 21 valuation for this slide. And this slide demonstrates this visibility that we have, and Jonathan has referenced this earlier, this long-term contractual characteristics of the cash flows. And this gives us a strong and predictable cash yield. So we show you the key assumptions, but what I want to draw your attention to really is bottom right, where we've got the average earnings cover more than 1.1 times and average cash cover of more than 1.5 times over this period that we illustrate. And this latter part, the cash flow and the strong cash cover, also gives us the opportunity to reinvest the surplus cash, and that can enhance the capital value over time. So this projection shows the expectation that the dividends to shareholders can grow progressively alongside a growth in NAV over time as well. If I can move you on to the financial results. So I'll go to slide 16. And here I'd like to draw your attention to the following, which is the 2.81 pence per share of dividends declared so far in this financial year, and that we're on track for our full year target of 5.62 pence per share. The earnings is 3.3 pence for the period, the 6-month period to September 21, and that provided good cover for our dividends declared. The cash cover was 1.2, and that is in line with our internal expectations. Profit before tax was 23 million, up 34% compared to 17 in the prior period. The increase in profit is driven by a larger portfolio in absolute terms, but also the resilient performance of the portfolio, which we will describe shortly as part of the valuation section. So in pence per share, the earnings was lower, but this is a function of when in each relevant period we undertook capital raises. As both this period, as you well know, and in the comparative period, we had quite significant changes in the underlying issued capital of the company. You heard earlier that the NAV has increased 2%, or in fact also 2p, to 104.5 pence, up from 102.5 at March. And in pound terms, the NAV has increased 36% from 694 to 943 million. So in summary, the NAV is up, profit is up, dividends are on track, and good earnings and cash cover was achieved for the dividend, which we're really, really pleased with. If I can now move you on to the valuation section. So The bridge or the chart is on slide 17. Much of what I'll describe is in the narrative on slide 18. So as previously, the portfolio evaluation at September 21 was prepared by the investment manager. We've used the same valuation methodology that we've always used since IPO. And as always, it was approved by the board and it was reviewed by PwC. So at September, the portfolio valuation was 785 million, a total increase of 42% on the portfolio valuation of 553 at March. And after adjusting for the acquisitions that we described earlier, which equated to 208 million in the period, and the cash received from investments of 27 million, the rebased portfolio valuation, which you can see on the chart in the previous slide, is 734, and it's from this rebased valuation that we measure the portfolio return in the period. So the portfolio generated a return of 32 million, which in percentage terms is 4.4% in the 6-month period. So what is this made up of? It's made up of the expected return in the period, sometimes referred to as the unwind of the discount rate, and then a few net upsides on the valuation. Now, these upsides included, Jonathan referred earlier to the additional 35% stake that we required, the remaining stake in Primary Energy. And as a result of that transaction, we were able to take an uplift in the valuation of over £10 million. Also included is an additional 2 million upside on the assumed revenues from what we call renewable energy certificates, or if you want the acronym, RECs, also in the primary energy assets. And as part of our asset management activities, we worked with the management team in the Oliver Spanish cogeneration assets to internalize or bring in-house the gas procurement activities. And we're pleased to see a £2 million upside on our valuation as a result of the savings that in-house gas procurement can achieve in the medium or near term, in fact. We spoke earlier, or Jonathan spoke about the EU ETS costs, and these have continued to rise in the near term. So partly a provision against this increase and the short-term volatility that we've experienced in the commodity pricing. This is all near term, but on the near-term side, we've included a provision of £4 million in the valuation. So overall, exceeding our target return for the period through the 32 million return on the portfolio. We briefly mentioned COVID earlier, and in this instance, in this 6-month period, as it was in the previous period, no material impact from COVID on the financial performance of the company. In this case, materiality, if I apply the audit materiality of 1%, so less than 1% impact as a result of COVID, significantly less, in fact. The portfolio blended weighted average discount rate this is on an unlevered basis, increased marginally to 7.2, up from 7% at March. Two movements, a little bit downwards movement, 5 bips came from discount rates to 2 assets, one that became operational in the period, and the other one in Vaten Gas, in fact, where we completed a refinancing on significantly improved terms compared to that which we had in the project when we acquired it about a year ago. We also saw a 25 bips upward movement on the discount rate, and these came from the new investments that were made in the period at rates that were higher than the prevailing rate at the time. However, we have noted a tightening, or you can call it a reduction in discount rates towards the end of the period, and certainly significantly also after the period end. And I think based on today's observations, I would say we would expect, if this trend continues or sustains the levels that we're observing at the moment, then we would expect to apply further discount rate reductions when we prepared the March 22 portfolio evaluation. Jonathan mentioned the hedging strategy. So yes, that has remained effective for us and in line with our expectation to minimize the net asset value from large fluctuations in the FX market. The two aggregate numbers may seem large, but they're not really particularly large. But 17 million uplift on the valuation side and 16.9 losses on the hedging side. And that's very much by design. That resulted in a 0.1 million effect from FX movements during the 6-month period. We do show you sensitivities. They're in the appendix, but just to bring them to your attention, on slide 27, we show you the discount rates, corporation tax, inflation, and FX, as we always do. Just following on from the inflation point that Jonathan raised earlier. So yes, the new acquisitions in the period resulted in an increase to the correlation to inflation. We don't aim to construct and maintain a portfolio of investments that are fully direct inflation-linked returns from these investments. However, we felt it was the right time to introduce some balance into the portfolio. So the new investments brought with them inherent inflation linkage, and to now approximately half the portfolio has inflation linkage in its revenues. So to summarize then on the portfolio valuation, we are pleased with the performance, really pleased with the performance of the portfolio. The outcome of the valuation, which showed good performance, continued resilience to COVID, and therefore remain excited over what will happen in the next 6 months and how the investments will continue to deliver the returns that we're targeting. So just moving you on to finally conclude on the summary financials. On slide 19 and 20, we've actually talked about much of this already, so I won't repeat all the things such as the profit and the net assets. However, I do want to bring your attention to the ongoing charges, which you're all familiar with. And we've seen further reductions in the ongoing charges through the ability to spread our ongoing cost over a larger capital base. And we're now at 0.99% on the ongoing charges, down from previous period and down from March as well. On slide 20, forgive me. On slide 20, just to point out that there was no debt at the end of September, and that's because we used the part of the capital raising proceeds to repay the debt. But also during the period, we increased the revolving credit facility from 40 million to 145 million. And it also has a further 55 million uncommitted accordion. Managed to expand the banking group from 1 to 4 banks. And this RCF will allow us to, gives the company the operational flexibility to commit to further investment opportunities as they arise. We've previously mentioned the debt at portfolio level as well. So again, on slide 26, if you're looking for further information on the levels of debt across the portfolio and also our compliance with the gearing restrictions. So Jonathan, just to finish, from a financial perspective, really pleased with this set of financial results. It demonstrates that the company is achieving its objectives and hitting key financial targets. So with that, I hand back to you.
Thank you, Eugene. Thank you very much. So yes, just to summarize from a financial perspective, net asset, we've grown the net asset value during the period. We're on track with our interim dividends covered by cash and by earnings. We've raised 250 million during the period, in fact, right at the end of it. But I think just as importantly, we've actually invested 250 million since March in 14 deals. So we've been active, and we're going to continue to find opportunities in what we're calling our organic pipeline, that is follow-on opportunities from our existing portfolio, as well as obviously opportunities to acquire assets that are EBIT and NAV enhancing in the market. I think really important point, we're continuing to apply our asset management initiatives across all of our investments. We've got a very well diversified portfolio across the US, Europe, and the UK. Our asset management team is very active. Some of the opportunities, as you've seen during this period, have generated profits during this period. Some of those activities where we're looking to expand capacity, increase revenues, manage costs, and improve overall levels of profitability. Some of those opportunities you can expect to see realized during this financial year. I think some of those opportunities you can expect to see in subsequent periods. These are infrastructure investments that are the subject of long-term asset management. But I'm very pleased to see quantifiable improvements being made across the estate today. So in summary, the company is very well positioned. It's positioned because we're sitting here in a global environment where there's more focus on decarbonisation. There is as much, if not more, focus on cost management. And managing costs and managing carbon are absolutely key to what SEIT is doing, providing solutions to energy problems, and indeed making more efficient, cleaner, more reliable energy solutions available and maintaining them properly for customers. We're able to do that and grow the company both through making additional investments in our existing portfolio, as well as by making opportunities available to the company for it to execute on. Income target for the year of 5.62p. We feel comfortable we're on track to achieve that during this year to March 2022. And just looking forward into the future, I think we continue to see opportunities. As I said, we're hugely focused on protecting and growing the value of our existing portfolio. But to the extent that we can find opportunities for the company, to make value accretive investments and add further to the scale, the diversification, marketability, and liquidity for shareholders, we will continue to do so. And just to put a sort of measure on that, we're currently working on project opportunities worth approximately 500 million, just over, compared to roughly 100 million of cash. So, the company can afford to be, selective, and we'll find the best opportunities for the company and continue to look to drive performance on. So, I think just on that note, perhaps I could thank you very much indeed for listening to our presentation and open for questions.
Fantastic. Jonathan and Eugene, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review those investor questions we've had through already, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the team can better understand your views and expectations. Jonathan, Eugene, we've had a number of questions that have popped up during the meeting itself. If I may just ask you just to click on that Q&A tab, and where appropriate to do so, if you could just read out the question and give your response, that would be wonderful.
Great. Well, look, thank you very much indeed, and we've certainly had some questions coming through, and I'll try and sort of answer them rapid fire. In each case, though, giving Eugene, if you don't mind, the opportunity to comment. And I would just take them in order of the way that they have presented themselves. First question: what would trigger an exit or a part exit of an investment? In fact, there are two questions. And then second, how competitive are you finding valuation and new targets? So in terms of an exit or a part exit, I think the basic investment policy and objective of the company is to seek to make good investments for the long term that will cover our dividends and provide long-term value, capital protection, and opportunities for growth. SEIT is not by definition a short-term investor. Having said that, the answer to your question is what would trigger an exit or a part exit of an investment is if we felt that there was more value that could be generated for shareholders by selling the investment than there would by keeping it. Currently, we're not in a position, where we don't. In other words, we feel that we can generate as much, if not more, value for our shareholders by holding on to, for the long term, our investments, managing them appropriately, expanding revenues, managing costs. So, but there are no sacred cows, and we would certainly look at triggering an exit if we thought there was exceptional value. And we could not afford to hold the investment. Eugene, is there any other points you wanted to make on that? How competitive are we in finding valuation in new targets? We do have a significant advantage, which is that given the fact that we've made a significant portfolio of investments already, a lot of the investments that have been made, we have also sort of rights to make follow-on investments, often at predetermined rates of return. So that provides a very fundamental defense against yield compression in the market, and indeed some real fantastic optionality for the company to continue to follow on. So that is one area which maintains our competitiveness. The second area, frankly, is that we are trying to avoid hotter areas of competed markets, where and indeed participating in auctions where we don't have an angle. Instead, finding opportunities to do bilateral or privately negotiated deals, or participating in an auction if we have a real angle, and maybe if we can get ahead of the auction. And I think all of the major investments that we've been made from memory over the course of the last 6 to 9 months, Eugene, have taken that character. They're either follow-on investments or they're acquisitions that we've made in the market, but normally on a privately negotiated or bilateral basis, and getting assets before they go to auction. Eugene, any comments you wanted to make?
No, not for me.
Question, actually, this will be interesting for you, Eugene, but the question is, the fund now has some stakes in project developers. What's the approach to generating value for these? So first of all, the main rationale for us to invest in developers comes alongside the opportunity for us to follow on with project level investment opportunities. So probably the notable ones to date would include positions like Onyx or Fez Lighting. Onyx is for solar and storage assets in the United States. Fez Lighting is for lighting projects. There is obviously a secondary benefit to owning stakes in the developers, in each case 50% for See It today, which is these stakes in due course can be accretive to the value. And Eugene, maybe just over to you. Our valuation methodology is predominantly discounted cash flow basis for our project level investments, but of course we will be looking to fair market value any sort of development businesses that we acquire on the way.
Yeah, and definitely an area that we're very interested in at the moment. And from a valuation perspective, one of the reasons why we wanted to have that flexibility of investing or have the potential to invest in developers is that there can be significant upside in value, and we don't want to be left behind, or we don't want the shareholders to be left behind if there is value associated with what we do anyway, which is the strong, predictable cash flows from the projects.
So far, I would have to say, having said that, so far the stakes that we have in project developers have typically come part and parcel of a project level acquisition. So fundamentally, have been valued as part of an overall discounted cash flow valuation. Although I do think that there's an opportunity, you're correct to point out that there's upside associated with that. We also took permission from investors on in our August AGM to place up to 3% of our capital into developers, operators, or managers of energy efficiency projects. So not necessarily projects on day one, although we have not actually to date used, I think, any of that budget so far. Sorry, Eugene, were you going to say something?
Yeah, I was going to say I'm happy to take the next one. Also from Solomon. So the question is, do we expect SEER to present information on portfolio company discount rates, other valuation metrics, and performance against budget? Inherently, we report the performance versus budget, because every time we do evaluation, we look at historic performance and how that impacts the future. And if there is a material reason to adjust the valuation, we will call that out. We show you the weighted average and also the range of portfolio discount rates. Don't necessarily have plans to sort of present each and every portfolio discount rate at the moment, but Solomon, perhaps if you want to get in touch, we'd love to talk that one through with you and understand what is valuable to you as an investor, including with you refer to other valuation metrics. Again, we'd love to understand. If you on the SEER website, there's an email address to contact us, so please do get in touch.
Thank you, Eugene. there's a question that's come in, which I think is a clarification fundamentally. It says, can we comment on how the external asset managers compensated or incentivized? So my comments during the course of today, including the one that's right up on the screen in the middle of it, continued performance together with active asset management initiatives. Those active asset management initiatives we're referring to. So we have at SDCL, we have a dedicated asset management function, and that's compensated as part and parcel of the overall management fee, which is paid to SDCL. That's in the prospectus and in the report and accounts. Is the tightening in discount rates you've noticed, this last question we've got on the screen, maybe go up to verbal ones, but is the tightening in discount rates you've noticed in recent transactions still to be reflected in the valuation? I think there's another part to that, which is about impact on future returns. So, I mean, Eugene, I think it would be fair to say that there has been no material adjustment in our weighted average discount rate across the portfolio as a result of witnessed or observed discount rate compression in the market at this point, at this valuation point on the 30th of September. So I think the answer to the question, Eugene, I think is no. We have not passed that through into our valuation at this reporting period, but we have flagged that it's something we're going to be monitoring carefully for the second half of the year. And if we do see the trend continue in terms of discount rate movements, then of course that's something that we'll need to take into account for the year-end valuation.
And that's correct. We saw that in the lead up to the 30th of September valuation, but wanted to see how consistent that will be in the market. And as I said earlier, and thank you, Miguel, for allowing me to clarify this. Yes, it wasn't taken into account. We noticed it, wanted to see the trend. The trend has continued, but we will clearly monitor this between now and when we prepare the March valuation.
There was another question as to whether or not it impacts our returns. I think just one observation is that our weighted average discount rate actually went up during the period rather than down. We often get this question, we always get the question about whether or not competition is going to drive down our sort of returns generations capabilities. What happened in the last period is that it drove up. So our project investments, new ones added to our existing ones, actually increased the discount rate from 7 to 7.2% because we were investing north of the weighted average cost of capital of the company. I think in future, there are two answers to the question, one of which, as I said, some of our investments, particularly when we've got follow-on investment rights, carry predetermined returns. So we've got rights to invest on predetermined rates, which defend against falling discount rates. Secondarily, we are actively pursuing opportunities where we've got an angle, where we can add value, where we can secure opportunities either off market or on a privately negotiated or bilateral basis. Yes, we did present a funnel at our year end, which showed actually quite the level of attrition that we have in our pipeline, in our funnel. I think at the year end, Eugene, I think we showed just over 4 billion of opportunities that went up through, a significant consideration gate here at the management team, and only 15% of those made their way through to an investment decision. So of the 85% of the significantly advanced deal flow that we progressed in the last full financial year, of the 85% of the deals that we didn't do, the single biggest reason for not progressing, would have been around returns. Sometimes around credit, sometimes around performance, sometimes around market or demand-based risks. But in those circumstances, we've been able to be highly selective and still add, very significantly to the new investment book for the business.
That's fantastic, Jonathan, Eugene. I think you've covered off all those questions from investors that we've had through. And of course, if any further questions do come through, the team will have the ability to review those questions and we can publish responses where appropriate to do so on the Investor Meet Company platform. Jonathan, just before we go and get some feedback for you from the attendees, if I may just ask you just for a few final closing comments, please.
Well, thank you very much. And just going back to what I said at the beginning, I think we are really pleased that energy efficiency is starting to become its own category. I'd say this from a global perspective. I think governments are realizing and recognizing the role that it has to play. That's why it was included in the Glasgow Climate Pact. We're seeing companies commit to net zero carbon, at various different dates over the next decade, and governments over the next 2 to 3 decades. So I think the trend towards decarbonisation and the sort of increasing focus on energy efficiency, I think bodes very well for the growth of this market. As the market grows, SEEIT has a greater level of investment universe to invest in. I think it's got great competitive advantage. We feel very comfortable with the portfolio we have today and that we can add value further to it over time. And we feel that there are other opportunities for the company to continue investing at attractive rates. So I also wanted to say many thanks for our shareholders who supported us during the course of the year in 2021. It was a big year for us, delighted to have entered the FTSE 250 index. And our shareholders can certainly count on us to be working incredibly hard on their behalf into the years to come.
That's fantastic. Jonathan, Eugene, thank you again for updating investors today. Could I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of SDCL Energy Efficiency Income Trust PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good morning.
Thank you all.